Okay, folks, welcome to Market Trends. I am David Russell, Global Head of Market Strategy at TradeStation Group. It's great to be with everyone. As usual, if you want to go to TradeStation.com, I'll show you some disclosures here to begin. If you want to go to TradeStation.com while I'm showing these to you, and then go to Research, the Research tab, and then the Insights tab under that, you'll come to the Market Insights blog, where we have a blog post, as always, the first blog post with some key points we're going to be discussing today. Called Technicals Weekend as Geopolitics Haunt Earnings. I think haunt's a good word because, I mean, we don't want to talk about geopolitics and everything happening in the world, but it's something that's out there. And I think one of the other things that's out there about it is it's a relatively new thing to really have any kind of significant risk from geopolitics. And I think that there's kind of a few things happening that I'm going to get to that I wanted to cover. But very quickly, if you go to start on TradeStation, wait a second, TradeStation.com. If you go to TradeStation.com, then you go to Research Insights. And then this article right here. As usual, we have a lot of the key points we're going to talk about. And if you want the workspaces that we share, they are available with the zip file here. And if you want to look at the ideas we've done on TradingView, they are here. Now, I want to mention, next week, we are going to attempt a different software instead of using Zoom for this call. So if you have this saved in Zoom, like as a recurring Zoom reminder or something, next week, actually, if you're on TradeStation.com, let me just show you here. If you're on TradeStation.com and you go to Learn Events, we're going to have, it's not up yet, but we're almost certainly going to have a different link for this event. It's probably going to change. We're trying a different piece of software that will allow us to stream to YouTube and Twitter and stuff like that. You'll still be able to watch it, from the TradeStation website. So I just wanted to tell you guys about that. That will almost certainly be happening next week. All right, so look at the market overall. I want to just kind of start with the technicals because, the thing is, I have been, as many of you guys know, I've believed that we're in a very positive period. I've talked about the fact that the inflationary situation is getting better. I've talked about the strength of the American economy, and I think all of those things are true. But I also believe that at this point, it's hard to ignore that some of the technicals are not really, get the right article here. The technicals here are getting more challenged. So to me, what's a concern is if you actually look here, these are, this is more or less the chart I use to create it. This is a weekly high. We have a series of all these weekly highs are lower. And what's also interesting, if you look at the way I drew this trend line here, you can see that the drop got steeper. So we have this, and then we have this. The other problem for the bulls, now if you look, the 20-day is under the 30-day. The 30-day is under the 50-day. Now, not a lot of people use the 30-day. I don't know if it's all that useful. Although sometimes I find that it's surprisingly useful. Like, look how it marked these tops here. 30-day simple. But the key thing to me is that when you look at this is an intermediate term downtrend now. We stalled under the 100-day moving average. And I've said that I believe the 100-day moving average is actually more useful than the 200-day. Now, the 200-day is right around down here, and I don't have it on this chart. The other thing is we have this gap down right here on that last Fed report, and you can see we were not able to get back through it. Now, when we zoom out, there's this very important level from last summer. Force this thing. It's at 43.25, this high. Boom. And, if you look at it, we are right now, we have been just trying to cling to it. Last week when we did the webinar, we basically said if we hold 43.25, we are going to rally, and that's exactly what happened. We came down, held 43.25 in here somewhere. I'm trying to look back to the date. What was last Thursday? It was on the 12th, sorry. So basically we held 43.25. We rallied back into that close. We dipped the next day and then we bounced again. You can see that there were some good bounces as we held 43.25. That was that level. And this 43.25 level was also important. I'm going to just draw a line at it. I'm going to go to horizontal line. 43.25 is right about here. Close enough. You can see, of course, we bounced here in late June, mid-August, and now you can see resistance there, trying to hold it as support. And now right now we're at 43.07 on the cash. So to me, this looks like we're breaking now something, more significant now. I'm not saying it's going to be a significant downtrend, but what I'm saying is that everyone expected a rally in Q4. Everyone expected strength as the quarter began. And so we got it. But now the question is, when you look out further into the future, it's, I believe there are some things that are happening that are more problematic. And I believe that, well, they're potentially more problematic. The market can only look out into the future and look at the odds of things happening. And something like the situation with, the Middle East. I mean, it's plausible that if Israel does, ground invasion and stuff like that, that there's going to be more uncertainty and turbulence in the region. There could be worries about oil supplies. There could be, other countries doing diplomatic things against us, things like that. Who knows? But the thing is that if you want to put on risk and you want to be bullish, does it make sense to do it before or to do it after? And I think that's the sort of thing as well. And I think that's actually now what is happening in the market. I think there's almost no surprises right now in financial markets, aside from maybe the amazing strength of this economy that simply will not sit down or slow down in any way. So we have I believe right now, the two things that are just becoming more of a problem that is preventing this intermediate term trend from turning neutral to then turning bullish are the strong economy, which pushes it. 10-year Treasury has not yet hit that 5.25 level that the long-term chart suggests it needs to go to. It remains, just drifting higher. So you have higher interest rates, higher for longer. That's one of the things we want to, one of our points here, that if you look here, the combination of higher for longer and geopolitical risk may pressure valuations. In my view, this is really what's happening now. And Tesla earnings, Apple earnings, none of that really matters as much as the fact that right now the question is, if interest rates keep going up toward, 5% or higher, if the Fed hikes again, if situations in the Middle East get worse before they get better, does it make sense to buy the S&P where it is right now? And I think that's the question people are asking, and that's the kind of uncertainty that we have at this moment. And so I think that we need to think about things a little bit differently than we have. It's not just a question of inflation getting better, because this week's retail sales, mind-blowingly good. If you look at initial claims today, back under 200,000, very strong. So those things together, Jerome Powell came out today, and he was essentially, I think, more on the hawkish side, but he kind of kept in that spot where he just wasn't going to wasn't going to throw a bone to anyone hoping for a dovish sort of turn. He kind of maintained that position of just saying inflation's too high, and we don't really know how much of our past tightening did anything useful. So I think right now, that's the reality we're in, and it's much less about individual companies. It's much less about anything except the fact that we have an equity market that, if you say there's no rate cuts next year, or there's more geopolitical risk, like this thing that the Biden administration did with the Chinese, right here, the Chinese chip stocks as AI, the AI chips. We saw this yesterday. This is bad for multiples, because you have uncertainty, the long-term growth of NVIDIA and these sort of companies. It now sucks out the willingness of people to pay like 40 times earnings or whatever they're paying for a name like NVIDIA. The other thing is that this week, look at Apple. This, to me, I would not be surprised if this article, and this was in multiple places, but Jeffries basically said that Apple is losing market share in China. Now, I honestly look at some situation in China right now, and you have to wonder, and I don't want to get into like geopolitics, but if you look at it, like China's in a spot right now where China and Russia are kind of like going against the United States on a diplomatic level. Well, if I was China, and then Biden does this stuff with the chip. So if I'm China, what's something that would be an easy way to kind of hit back on the United States? What would happen if they start doing things to discourage, iPhones? That would be an easy way to hurt the United States. And the other thing is that even if it's not an official policy, what happens if just for one reason or another, the Chinese growth engine of Apple goes from running it, in fifth gear to running in third gear? And that seems to be what this article is saying. So maybe it's geopolitics, maybe it's just market shifts, maybe Huawei has some great product. I don't know. The key thing is that Apple needs to execute at a really high level. And if they don't do that, then people say the multiple is too high. Nvidia needs to grow at a breakneck pace, or people say the multiple is too high. So you have the combination of that longer term uncertainty that is now emerging, that is tied to geopolitics in a way, but it's also tied to higher interest rates. And you put these things together. This week, we saw kind of body blows to Apple and Nvidia. And these are not sideshow stocks. And before, one of the things that made me so interested in AI that seemed interesting about it was that this was going to lift the major stocks in the market. Apple, Apple off the bat, but it was going to lift Nvidia, it was going to lift Amazon, it was going to lift Google, it was going to lift Microsoft. These were the big names that were going to benefit from AI, and that was the exciting thing. But now, if we're in a spot where that narrative goes away and it turns to the big names are now going to suffer from geopolitics, or whatever is happening. I don't even know what this is, geopolitics, but if it's simply going to be less amazing growth, then the multiples are a problem, especially with interest rates going higher. The problem ultimately with Apple and Google and Microsoft is they're not that cyclical. So yeah, it's great to see. Look at GDP now. I mean, it's stunning. Look at the GDP now from the Atlanta Fed. This is awesome, right? We're running at like 6% or something here, 5.5. That's great, but the problem is Apple's not that cyclical. Nvidia is not that cyclical. When you're a pure growth stock, you don't benefit from a recession, but going from 3% GDP to 5% GDP really doesn't help Microsoft that much. If anything, it hurts them because, again, what does it do? It drives up interest rates, and then the multiple becomes a problem. So we're in a little bit of a spot with that right now, and I feel that that's something that creates a degree of difficulty for the market. And part of me has thought that maybe we just need to see that 10-year touch 5.25, and then the money's going to come off the sideline. This is the 10-year yield. I don't have it readily on this chart, but if you look back, maybe I can get it. I have too many charts. I have to confess. I have too many charts on too many platforms. I have my personal ones on one screen, but look here. All right, so this 5.25 level from 2006, 2007. We're just not there yet. And I wrote about this like a month ago, but other people, I mean, everyone and their brother is watching this level. And my view is maybe if you want to be, saying that yields have peaked, we're not there yet. So then the problem simply becomes, why buy anything until I know that yields are done going up? If you look last year, the market, let's actually look now on a weekly chart, the market bottomed in mid-October, and where did yields, yields peaked basically a little bit after where the market kind of, turned. But, if you have that level in mind, this is something that hasn't shown any sign of backing down on that front. So like I said, these are the bigger questions here. These are not individual company narratives. This is a bigger macro question right now that's kind of unfolding. All right, let me just go back here quickly, S&P, because, sorry, just this SPX.X. I don't have it on this chart. I might have it on a different chart. There's the 8 and 20-day moving average that, put this back to the daily. Like I said, this price gap, this is the intermediate thing. And what the question now is, I think that this gives us a lot of meaning here. The question is, does this become a real lower high? I mean, it's already a lower high on the weekly. The question is, do we now go down and make a lower low on the weekly? Do we somehow grind and chop here and these moving averages flatten out and improve? That's, I think, the big question. Now, remember, the 200-day is right down here. I don't really know how incredibly important that is at this point in time. I think that we really are in this kind of neutral thing here, and we're going to see, does this global situation get better or worse? What happens with Congress, with Speaker of the House? What happens with, the next economic data and all these sort of things? So I think now we're in a period where I'm not going to say that it's not really that bearish when you think about it, but from the intermediate term, it's very sloppy. And, you know, this is a sort of thing when viewing the ranges could make more sense and thinking about, you know, do we get a test down to these levels? But at this point, in my view, we have something of of a short-term bullishness here, um, that is now fading, and the intermediate-term bearishness is reasserting itself, and the longer-term question is still bullish to neutral. But now that we're stalling under this 100-day, now that we have these lower weekly highs, the longer term is not as clearly bullish as it was before. And we could just be in a period of neutrality for several months into next year until the Fed somehow stops, doing what they're doing. If, and that's to say we do, but if inflation does continue to come down and we get to that spot when inflation is close to 2% and the Fed is done, then it's a different story. But the problem is we're not there yet. And what happens if the inflation thing is not as good as people think? What happens if it really does spread? What happens if oil continues to push higher? Then all of those become more of a question. So that's why right now I think it's just a period of this kind of neutrality, or this kind of short term getting a little bearish, potentially intermediate, not so great. So I'm going to be kind of watching some of these moving averages to see if they can kind of turn around. I've noticed that sometimes the 20 and the 30-day, the relationship between the two sometimes can give you some signals. Honestly, I haven't seen it work for a long time. When I used to work at Option Monster, we used to use that signal, but that was many years ago. But it might come back into play. I've just noticed that sometimes when you have this trend between the 20 and the 30, it can remain in that direction for a while once it's established. See, we saw it here, but then it gives false signals too. So now, I don't know if I have it on these charts, but there's the 8-day and the 21-day exponential moving average that some people watch. What's interesting to me, I'm going to actually quickly jump over to this. I was making this other little chart today, but let me just show you this other. I'm going to make a really quick chart and just show you something here. I'm going to go to the daily of the SPY S&P 500. And if you just go here and you go to studies, add study to moving average exponential, 2 lines, and we go to the 8 and 21 that some people use. What's interesting is yesterday we tried to have a bullish crossover and we failed at some point during the intraday. You can see here the 8 and 21. For a few hours or minutes or something, it was above. But then when it reversed lower, so to me, for some people who watch this is actually a very bearish short-term signal. So I did want to point out that's the case. I don't know what I think of the 8 and 21, but there are people who watch it, so I did want to mention it. I included it in my notes. But this could be something that's troublesome. What I tend to watch for the short term is the other thing I watch, and like I said, a lot of people don't watch this one, but this is one that I like, is just the simple 10-day, the 10-day simple. And I'm going to make it yellow just so you can, quickly see the difference here. But this is also one that you can see that we tracked right there, we tracked there, and then we broke under it. Now, the one thing I'll say about the 10-day is you can touch it once or twice, but then after that, it dies. So what's interesting is you can see that we kind of bounced there, but once we got under it, it's now invalidated in my view. So to me, this is something where we have to be careful of this becoming what looks like kind of a bearish flag and an intermediate term downtrend. I mean, but I wouldn't place too much in that. The thing that's really interesting to me right now is that if you look at the AAII sentiment, we remain at a spot where, there's really not a lot of complacency. There's a lot of negativity in this market, overall. This is near the lower range, 34% bullish. I mean, that's not the lowest, but it's near the end of the bottom of the range. So there's not a lot of, excessive, optimism here that can result in a lot of overall, selling. And that's why I think it's going to be a period of kind of neutral, but the shortest term signals we see are flicking more to the bearish side, especially our inability to hold 43.25. To me, that's the single most important thing. And then also the discovery of resistance at this gap. So let's now look at some of the other points I wanted to cover here. Close this. So the retail sales number, it beat for all 3 months. Because remember, this was the September number that came out this week. It crushed estimates. I think it was like more than twice the estimate. All 3 months of Q3. So right now, this number, and this is the Q3 number, right? For Atlanta Fed, I mean, all 3 months were above estimates. And if you actually look at the retail sales, you can see it added 0.2, percentage points of GDP. So these things right now also kind of pointing that direction. So it's interesting to look at the airlines. This was something that kind of grabbed my interest because, we had talked a while back about the leveraged cyclicals. We had talked about the rally in them when times were good. The things like the Norwegian cruise and all that. And then if you kind of look at what's happening with United Airlines, the combination of higher energy costs, higher labor costs, but then also the debt in all these companies. A lot of these companies are carrying a lot of debt, and that just remains a problem. And so I think that that was just to me kind of interesting. But the things this guy said, if you actually look at his interview on CNBC, I mean, it was pretty actually bleak. Kind of saying that the business models must change for the airline industry to survive and stuff. So I mean, this is, to me, it kind of says a lot. And as I look now, the other thing now, Rite Aid's been a sloppy company forever, and they went bankrupt or something. I mean, but the key thing is, if you actually look at what they said here, there was one line. Look at this. Their interest expense rose from 52 million to 72 million. And this is what we're talking about. And this is why last webinar we were talking about things like enterprise value to market cap. We're talking about how companies that have a lot of debt, they are suddenly airlines, United Airlines, American Airlines, they all have a ton of debt. And as interest rates go higher, and as you price their business models into the future, as you say, all right, they were, borrowing at 4%, now they're going to borrow at 8% or 9%. The whole EPS disappears in front of your eyes if you're modeling these things. And so I think that's really, this is now, I mean, the Rite Aid is just an example of that. But the thing is that this becomes just kind of a problem across the, a big chunk of the market. And it's just another sort of a thing that we could start to get a drag of more bankruptcies, more insolvencies, more bad debt. Nothing that is bad enough to cause a recession, but just things that are bad enough to drag on the market and create problems here and there, like in the airlines, for example. So what's interesting here is Apple had really, in my opinion, two articles that were both pretty negative. One was this thing here about, like I mentioned, this Huawei note from Jefferies that was on October 16th. The other one was on Wednesday, October 18th, when this gentleman, Ming-Chi Kuo, I've never been able to figure out what firm he's at, but he's considered like a guru on Apple. And he basically said that they're doing badly with MacBook and stuff. And so, like I said, this is real news. And then you also have basically the situation with the chips. And then the other thing is the Tesla numbers. They missed on revenue, they missed on earnings, their margins, again, margins, which is what happened with, debt servicing costs. Was that due to margins? Well, Tesla missed on earnings and revenue. Their margin got cut in half. Now look at this article from Reuters. Tesla joins GM and Ford in slowing EV ramping. So right now, like, this was supposed to be the great growth of the future, and now they're slowing that growth. So again, what multiple are you willing to pay for a company that's not going to grow as fast as you thought, that's not going to have margin as high as you thought? And I think that's really the thing that's happening here. And, I'm not an expert in autos or anything, but I think if you think about it over time, I think the risk is I mean, and this is a little bit of an exaggeration, so don't think I'm just totally crazy, but it's funny if you actually go back and you look at the first Mr. Coffee. It was like a $200 thing or something in like 1980. And now you can go to Walmart and buy a coffee maker for under 20 bucks. Now, the point is that what happens if electric cars essentially do that? I mean, there's a long history of consumer electronics that used to cost us VCRs, DVD players, everything. And the only thing I have to say is, what happens if electric cars follow the same trajectory of a race to the bottom? And when you look at what's happening with these Chinese names, Li Auto, these companies coming out of China, and you look at the headway that they've already made in Europe, I think you have to ask long term, are any of these companies demanding? Now, I'm not going to compare Tesla to like, a Walkman or something, but I'm just saying, if it becomes a consumer electronic product at a certain point in time, the question is, and you look at what's happening with pricing, you look at what's happening with the Chinese companies, you look at articles like this, then the question simply becomes, does it demand a multiple that it has? And I'm not sure. And I just look at this, and again, maybe after the 10-year hits 5.25, people won't think this. But right now, I think until it hits that level, until we know the Fed is done, then basically these sort of issues can become a question. And I think right now that's kind of what we're seeing. The results today from something like Tesla. I think this is, kind of it's more than just missing on this or that or something like this. I think these are bigger existential questions now about what multiple should things have in a 5% in a world of a 5% 10-year. What multiple should it have when the Chinese growth story might not be as good as we thought? When China and the US might be throwing stones at each other over global trade. And then I think this is the real weakness that people have been complaining about on the big tech for a long time, which is that even though they have amazing businesses, the question is does the multiple hold up? And I just think that's really what's happening right now. All right, so the housing data very weak overall. I think none of that's a surprise to anyone. There's some interesting notes. There's an interesting note of basically Morgan Stanley really bullish on Meta. And it's interesting when you think of a name like Meta, you think of a stock like Alphabet. Those companies don't have the same sort of risk of China. There's something to think about. They don't have the same sort of risk of things like pricing and things like that. So I would not be surprised. Interesting when you actually look. If we look here, let's go to our price grid and put in like the really big, NASDAQ stocks. Put in Google, Meta, Microsoft, Tesla. This is price grid and the MT main. NVDA. What am I forgetting? Amazon, Apple. Let's look at the 21-day performance. Meta, Microsoft. Well, Google, I mean, is doing pretty well. Microsoft's kind of doing better than I thought today, but Google is doing a lot better. But look at these. These are the guys that don't have that same sort of like, Chinese sort of geopolitical semiconductor risk. So I think it's just kind of interesting to see that this is being reflected to a certain extent in the numbers. All right. Let me go on now to the Netflix was very strong. And, honestly, I had done kind of a positive note on TradingView some time ago, looking at Netflix. And I was really surprised by the weakness that came along and hit it. Because it seemed to me that their password crackdown was a game changer for their business. The market basically forgot about it. We had kind of written about this being an ABC correction, and we had actually done a TradingView idea when it was right around here, and it bounced nicely. And then a whole bunch of other negativity came in. But it could be interesting to see if maybe this was just like, a kind of negativity bubble that now maybe reverses here, especially when you think of what's happening with Meta, because why? Meta, Google, they are in the XLC. Now, remember, What is the top performing sector year to date? All of a sudden, XLC. It replaced XLK. Okay, so these are the spider funds. I don't have them broken out that way, but the communications are now the top performing sector this year. XLC, and that's Meta, Google, Netflix, things like that. So these guys within tech, they have a degree of insulation from the China risk, unlike XLK, which has Apple and has Nvidia, and it also has a bunch of other semiconductor stocks. I think right now semiconductors are just in a very vulnerable spot. There's this other article that I don't have here, but it basically said that China is now making things like AMAT, applied materials, the equipment stocks. LRCX last night had earnings that were kind of good, but not terrific. And it fell after hours. Here it is again. So I think right now it's just kind of interesting to see that there's this article that basically said Chinese chip equipment companies that compete with Lam, compete with AMAT, compete with KLAC, compete with TER. These are the semiconductor, capital equipment stocks. These guys, TER, KLAC, these guys are now kind of, at risk, I think, of any kind of, trade spat with China, anything like that. All these now are kind of on the list of names that are at risk. Those will be the guys that will really be hit by, these kind of trade disputes and things like that. So some of the other things that popped up that were interesting to me was if you look at a lot of the the property and casualty stocks have been doing very well, and really unglamorous, sort of uninteresting names, but we've seen some real strength in some of these stocks. But these also tend to do well in a kind of risk-off environment. So from my perspective, if you look last year when the market was doing badly, look at how Progressive did. It just trended higher all year. AJ Gallagher's in. I mean, I'm sorry. Honestly, I almost usually throwing tomatoes at me for saying stock like AJ Gallagher. Nobody trades this thing, but look at the price section. Another one that's been interesting that might be worth getting to learn about is AIG. Now, this was a company from way back, but it's a property and casualty. But Progressive is the one that really stood out, and Allstate. These are kind of jumping here. So when the market is doing poorly, I've noticed the property and casualty stocks have had the ability to go against that. And that's an interesting thing to notice. Now, last week, we had kind of talked about everything happening in energy. And, energy to me now is in a very strange place. I'm not sure what to make of it. We did an article earlier in the week. Yep. We're breaking lower, kind of. It just seems to me like we've got to go down and see, are we going to make a higher low? I think that's really the question. Are we going to make a lower low? Or are we going to retest the low and make a double bottom? That's really the question here. Let's look at, let's just go back to my MT blog. Sorry, this one. Let's just keep this chart open. This one. This level. Let's see. I mean, 4,200. Maybe let's just see. I mean, maybe we just need to really dig down to 4,200 before people are, 4,200 on the S&P, 5.25 on the 10-year. Maybe that's the playbook. All right. So we did this article about oil, and it is interesting to me here because, I mean, this really comes down to how do you interpret the situation, in the Middle East? Will it get worse? Will there be an issue with Iran? Who knows? Will they get involved? Will we do something against them? This is totally open here. And when I wrote this article, I was thinking more along the lines that there was not going to be an escalation. I'm not sure if that's still the case. But I would just say is that if you really look, and what I'm saying here is that there are fundamentals in energy that might be weakening. There is signs of growth in this is American production, and we got this apparently this thing with Venezuela. So now we lifted our sanctions against Venezuela, and they're going to start having more oil. And so I think, I mean, to me, I think that there is actually some risk here of oil, where if this, let's hope the Middle East thing, nothing worse happens. But if that is the case and things get smoothed over, yeah, I think that the oil could have some risk. So I want to just point out that I think that I raised some points in this article that I think people need to be aware of. Now, the two things that argue against it is, first, let's, you know, just for the sake of being realistic, let's say geopolitics do get worse. So maybe this point is wrong. The second issue is that some of the Chinese data since I wrote this article was surprisingly good. And so now the question is, if the Chinese economy does start to kind of recover, and I remain skeptical of it because of the nature of their debt, but if it does start to recover, it could go against me. So I'm tending now to be more thinking that oil is probably more likely headed down. And the reason is because when this chart goes up of production, it doesn't stop. And so the thing is that there's other articles out there. There was a report, I think on October 4th, from the Energy Department that said American companies are starting to really increase production on oil wells. And what's interesting is that there was this whole thing of them buying back stock and stuff, and now they're actually not doing that as much anymore. Now they're investing in production. Historically, the way it works is this moves slowly, but when it does move, it just is a freight train. And so, from my perspective, we are going to see a ramp up of oil production into next year, and inventories will rebuild and prices will start to go down. And then if the Middle East improves, they're going to crash. But I'm not going to try to say that's happening. But this production growth is, to me, ultimately, and the thing of Venezuela and everything else, and the fact it's an election year, which means there's other tricks Biden can probably do. He can probably get the Saudis to do what they want to do. There's probably even ways with Russia where we could tinker with this or that thing in our sanctions that would allow more Russian oil into the market or whatever. It's a complicated thing. I just think it's important to realize there's a lot of news that's been priced into oil one way. But the thing is that if some of those things improve, when you consider the rising production, I mean, to me, this chart is kind of like the Fed for the stock market. The rising production of oil in the United States cranking out this much oil. I want to point that out, that I think we have to be careful of being complacently long in energy. I'm personally looking for an opportunity to be getting short. I don't know where it is. This is the XLE. If you look at this, I mean, it's kind of interesting to see these ranges here. I mean, does this turn into a lower high? I mean, it could. Look at this. It's slightly lower. Um, you know, let's see. I mean, this thing could just be, and I don't mean bearish like it goes down that much, but I mean, does this retrace back down this range? Just something to kind of think about. Um, I'm actually kind of looking for this trade, and you know what? I haven't done anything with it, but here we are at the top of the Keltner channel. We have an outside day. Just saying, and we had we had a huge inventory draw yesterday, and oil didn't go up that much. So I've just seen things like this before with energy, and I want to just point that out. That there are some reasons here to be thinking of that with energy. All right, so let me just continue here. There's been this horrific downside. Well, I basically mentioned here, some of these energy names outperforming, and I'm not really, like I said, I'm not sure what to make of it. The other thing though is you have that acquisition of Pioneer PXD by Exxon, and that created a certain degree of interest in some of these stocks. So I'd say I highlight like Diamondback Energy. It's kind of one of those names. So there is right now in the energy space a little bit of this belief, I think, of M&A in the in energy. Basically like when Pfizer goes on a buying spree and buys biotechs, well, maybe Exxon goes on a buying spree and buys a bunch of shale gas stocks and energy things, and some of the smaller producers. And I think that's part of the narrative. All right, so some of the signals that were popping up, and I think depending on the geopolitical thing, it's important to take a look here at gold. Put this on I'm going to go to over here. I'm just making these other charts. This is my problem. I start making charts and I end up with them everywhere. Um, but if we make this on a weekly here, I'm gonna just get rid of. I don't even want these studies. But this is basically I want GC for gold. But basically here, I think with the geopolitical thing, I think we have to recognize this. And it's funny. I was kind of thinking of a little joke, but I'll show you my joke. This is my joke for today. And I think that when you think of the situation we have, there's reasons to compare this current moment in time to the 1970s. It's starting to look more like that of geopolitical uncertainty, inflation, things like that. And I think that things are changing historically, at a global level. And when you have companies like Apple that have a global footprint, you know, those issues will remain, I think. And what's interesting here is despite a relentless rise of interest rates and strength in the dollar, gold is breaking out. And I mean, you can't argue with this. You can't look past it. You cannot ignore what's happening with gold right now. I can't believe it's up another. I can't believe it remains higher today when you consider jobless claims under 200,000 and gold is up 0.8% on a day. But look at this weekly. So to me, this is actually something that we need to have on our radar here. And I'm not really sure what to make of it. I'll be honest. I was trying to trade silver, and it's just a widow maker, and it didn't work for me. And anyway, but what's interesting here is that I might have just been early. I have a knack for being early sometimes, and but what's interesting is gold should not be going up with interest rates where they are, um, and it is. So it's a geopolitical thing. And I think this is important. Global central banks have been buying a ton of gold. If you Google that, central banks buying gold, whatever. Now, it's come from the Gold Council, which is not, a lot of people think that they're a bunch of crazies who just try and talk up gold. I mean, they're not, I think, a widely respected research firm. It's like an industry group, but they have claimed that this year and last year, that there's been record gold buying by central banks. People probably like Russia and China that no longer want to buy treasuries, they're buying gold. But one way or another, we have a weekly breakout in gold futures. And this is one of my signals for today. All right, another one, Amazon. Right when I took my moving averages off my chart, look over on this chart for Amazon. And on this one, you can see here, I actually have the 21-day EMA in gold, and we have the 50-day. So to me, this is, I mean, I'm looking at this price action, and this just, looks pretty gnarly to me. Now earnings on this one are next week, but I did want to mention here that this is also, you look at it, it failed this gap as well. JP Morgan, if you look at this, the way it tried to get above the 50-day, tried to get above the Keltner channel and didn't. So to me, this is interesting. If you look at stayed in that Keltner channel pretty well. And now the question is, does it go back down to the 200-day moving average? Does it go back down here? So I think that's totally the thing to watch. S&P at the low of the day. We're pretty much said sayonara, I think, to the 43.25. So last week when we were doing this webinar, we basically said held 43.25 upside, and it bounced for 3 or 4 days. Now we literally break it as I'm doing the webinar again. All right. Can we get the Atlanta Fed link? Okay, sorry. If you Google GDP now, Atlanta Fed. All right. Do you think USZ 23 have reached a bottom? You're asking about futures on bonds. For me, price, I mean, I've never traded bond futures. I look at bond yields, and you're talking about the USZ 23. So that's going to be the 30-year. And price will be, I mean, I'm not going to try and predict price on any instrument like this, but I'll just say that to me, the real issue remains the 10-year. Um, People are going to want to see it 5.25. The 30-year, in my view, will essentially follow what the 10-year does. I mean, not exactly, but there's the long end of the curve and not, and I think that you're going to see more of that activity there. So I think that you know, I think you need to. I think that right now everyone is watching for the 10-year to hit 5.25 before anyone can talk about a bottom in bond future prices. All right. All right, here was one I did a trading view idea on, trading view ideas, which you can get from our rundown here if you click on this. Wait a second, wrong one. On here at the top, we have our link to trading view ideas. We did this thing on Rivian. I did an idea on it here. And, to me, this was one that I've been kind of watching. And now it's after, Tesla, it's really breaking down. I mean, to me, there's a stock where if you actually look at the idea we did on TradingView, we did highlight the all-time low on this thing, which was this level from back here on April 26th down here. So, I mean, from my perspective here, when this is just a kind of gravitational force, I think, potentially in a name like this. The valuation is so high. They did their secondary offering here. And from a friend of mine who used to work at Rivian, he said that they did it earlier than, actually, it was an article on Seeking Alpha that said it was earlier than people had expected. So, to me, this is just, this is the kind of heartbreaker that you don't want. You look at the way that it had that low that became a high. So from my perspective here, people might see some gravitational forces of this name toward 12. Trades a lot of options, so this might be one. I didn't really see a lot of options opportunities today. I've been trading SPY puts myself, and just kind of focusing on trading, the kind of downside in the index. One of my kind of rules of thumb is that when you're in a period of downside and volatility in the broader market, you want to focus on the big indexes and honestly just the S&P itself, because you never know when one index is going to vary. In my opinion, you will often find that sometimes the Russell lags, which sometimes can give you an edge. Sometimes if the market starts tanking, you'll see that the Russell is like 5 to 60 minutes behind the movement of the SPY. And if we and sometimes that can give you an opportunity to actually look for the Russell to play catch up to the downside, not to the upside, but to the downside. All right, so Bank of America was near the top of its channel, and I did this yesterday. They had good earnings, but again, top of the channel, 50-day coming down. From my perspective here, this might be one. Look at how we had this level around 28 that had been a low back here in early September. Look at how it hit that level in late September, failed at it yesterday. Bank of America, 26. Will we see, a kind of retest back down? Some people might look for that. Another one, all right, this is a crazy former Kathy Wood stock, but this was like a total COVID stock. SE. Esports. They do like esports, and they had this thing of people like in Singapore betting on video games or something, like it was horse racing or football. It was a monster growth stock at one point in time. And, but here's the thing. We have this gap down on earnings, rallied back up, played with the gap a little bit, but it's at the top of the Keltner channel. Look at the 8-day exponential moving average coming up. Today, we actually could be on pace to close below it. So, I mean, to me, this is another one where the gravitational forces of that falling 50-day moving average, this could just be like a magnet. So I wanted to kind of point this one out that is interesting to the downside potentially. So we had Powell speaking today. I'm not going to go over my events here because I wanted to show you guys. I didn't actually list it on here. I wanted to just quickly show you some stuff that I've been doing with my own trading. And honestly, this is the market that works best for me personally. I just love trading downside in the SPY with puts. It's historically been my best thing. And so I'll show you some of the things that I look at. Now, I don't have any positions open right now. I kind of wish I had kept my puts open, but I didn't. So, all right, let me show you this chart that I kind of created. And let me show you what I have on here. Wow, look at this. Wow. All right, so let's look at this chart. This is just SPY. So what I'm going to do is, you know what? First, I'm going to do is I'm going to just take a new chart and start from scratch. And I believe this is some useful ways to look at. I hit Control Alt C, by the way, to open a chart. So let's look at SPY here. Let's bring up let's make it a 5-minute chart. Now, there's a few things I like doing here. Let's go to Studies, Add Study. Let's go to Paint Bar, and we're going to go to first bar of the day. And then we're going to hit OK. And I like just making it like a purple or a magenta color that I don't use anywhere else. I don't like that orange because sometimes I use this golden orange that it wants to give. I use that for the 21 day, and I don't use this purple very often. I only use it for the 30 day, which I don't use very often. So I do suggest that you try to stick with one color for all your moving averages. And there we go. You can see here that now each day, you can see the first opening bar of each day. And, I kind of like to look at this to see, where we stand on each day versus another day. Now, another thing that I want to do is I'm going to go to Studies, Add Study, and I go to Line, go to Indicator, Line at Price, Line at Bid, and Line at Ask. Put those on, hit OK. By doing this is going to let you easily chart. You can see right off the bat, wow, the current price is trying to hold this low. That's interesting. I didn't even notice that, but now you can see it. So I use bid and ask instead of price because for something like SPY, they're pretty much the same thing from a charting perspective. And the other thing is it allows you to see pre-market and post-market. So line at bid and line at ask. Another thing, if I go to settings, and I go to window, let me make sure I get this right. And I go to style, show session breaks, make it a solid line, and then make it bigger, and then hit OK. And now you can see each day, one to the next. Now, in the pre-market and post-market, you can also go to sessions, show pre and post-market, and you can see the price action. So this is sometimes useful in the pre-market to see where we are versus other times. I don't use it that often, but I wanted to show it to you. I make it go away by then going to futures. When you go to futures, it removes that option and it goes back to being normal only. Now, the other thing I wanted to show you is new high and low for the day. So if I go to Studies, Add Study, go to this could be actually the lights out time for this market. You do have to realize that there's a point of time when you go from a sort of chopping consolidation to a smooth move. And this could be S&P down 0.8%. So, I mean, if I was right about a move toward, 4,200, that's 80 points down, and that could happen quickly. So I do think it's interesting that now could be the time when you get that nice sort of acceleration and the moves go from being choppy to being just smooth. So I'm going to go now to show me. I'm going to go to new high for day and new low for a day. I'm going to hold down Control to put them both in. Now, for my new high, I like having white crosses myself. Go to color, I make it white, go to style and make that a cross. I make it a little bit bigger by changing the weight. So hit OK. Then my new low for the day, I like that just to be like a big yellow circle. And I go to yellow. And then what I do is I go to style and I make it really big, but then I make it more clear. I change the transparency to like 60%. And now look at this. So now by doing this, what it allows me to see is it allows me to see highs for the day. And it also allows me to see the lows in big, but by making them transparent. If it's just a little tiny one, then it's hard to see. I like it this way. You can play around with you want. You could have at the top, you could have big circles with, that are transparent. I like the contrast of having like a cross at the top and a dot at the bottom because my eye catches it more easily. One to just share, these are some things that I do. And for me, what I would say the signals that came out of this for me today were trying to think of how I traded this today. I basically bought puts around here. I saw that we opened up at that level, which was basically, it was this level you could see from yesterday. It was an hourly high. But the other thing is that it was also right around on the cash index, the 43.25 level. This was pretty much right there. So if you look at this level, kind of, it was a low here, it was a high there, and then we opened at it and we failed. And then as we consolidated under it, I bought puts somewhere in here, and then basically at one point I went negative, then it crashed, and I was doing good, and I got stopped out as we got the rallying to Jerome Powell. I kind of did poorly with that, but then I caught it from here and took it down to here, and I exited, going into my webinar, and now kind of wish I had kept it. But the key thing is that I could see these levels, and I was really kind of playing with those levels and watching them. And now if I kind of look at this, if you look here, I'm trying to think of some other signals that came out of this. You could see like a level right here. You could see very clearly how this had been, here was on the 18th, and here we are later on the 18th. You can just see how it continuously made those kinds of, you can see how the resistance kind of kept shaping up. You could see, oh, that was a low from the 16th. And here we are stalling at it on the 18th. Now remember that this line at bid ask would have been right there. So the same way that we can now see this low being held, and who knows if it does hold, but the same way you can see this low being held, you would have seen that high offering resistance. You would have seen, wow, this low is now this low, here we are, say yesterday, you would have seen that this high at 433, wow, this used to be a low, now it's turning into a high, I'm going to get short. That sort of way that I like using charts like this, and I find this to be, this has been something to me that has been helpful. We also have our MTES, which uses the futures, and on this, what I'll just say is that, MACD was bullish here, but the key thing is that stochastics went to an overbought condition with the falling 50-hour, which you could see here because this lower histogram was red. So we had 2 out of 3 bearish. And then, when you look at, it came down a little, but stochastics never went anywhere near an oversold condition. So we still had the falling 50-hour, and we were coming down from an overbought condition. So in my book, this remained a bearish sort of signal. If you look at other times here, notice stochastic hit right there, an overbought high at 1 o'clock on the 17th, and MACD was falling, and it also marked a high. So, this is something for futures. Remember, this has to be for futures when you use this. You look for 2 of the 3 to give you a signal one way or the other. So now we're at a spot where there's no clear opportunity. I would tend to think at this point, though, that when you consider the situation of the intermediate term trend now reasserting itself, and I would almost argue that this intermediate term trend that I discussed here, maybe this is when people first notice it, to be honest. This crossover didn't happen, and now people are like, oh no, we actually have an intermediate term downtrend. That wasn't true. We had intermediate term neutrality here, and now we have intermediate term bearishness. So to me, this is something now where people are starting to really maybe wake up and smell the coffee and see that this is now, wow, now we have a lower high in the weekly. We have resistance at the gap. We failed at the high from last summer. And I think all these pieces are now coming together in people's minds. Wait, let me see any other thing I wanted to mention. I'm running out of time. I was going to show you guys some of the things with puts, but I don't have time for it right now. It's great to talk to everyone. Looks like I didn't miss any questions. So I will see you guys next week. But remember, we are going to try to use a different link. So don't use the Zoom thing. Go to the actual, go to the events page on TradeStation.com and follow the link that is there. And I can tell you, we should have it up by early next week. So it should be in place a couple of days before, but just check day of. And we're going to try and transition this. I'm sorry at this point if it's a little bit up in the air. Appreciate you guys bearing with me. I'll see you guys next week. Have a good one.